Good afternoon, all, or good morning, depending on which time zone you're in. This is Randy Jones, the head of Originations for ApplePie Capital. I also have Ron Feldman, the Chief Development Officer for ApplePie Capital. Today's webinar, we're going to go through acquisition strategies or growth strategies, depending on whether you're going to buy an existing location or add new locations. Representing the viewers in the audience today, we have 79 different brands. 50% of them have between 1 and 10 units open. 25% of them are just getting started into franchising, and the rest of you have 10 plus units. Wanted to let you know that you could use the chat feature in the bottom left-hand corner of your screen to ask questions as we go through the slides. Many times the questions add more content to the topic, so we'll try to address them as they come up. Right now I'm going to turn it over to Ron to go through the topics that we will cover.
Thanks, Randy. 4 basic topics that we're going to cover today. First and foremost is the importance of having a plan on selling or growing or acquiring. The second would be, what are the healthy growth rates based on your operational capability? These topics came from the years of experience we've had with both good and bad experiences in folks buying or acquiring units, growing too fast, growing too slow, etc. Next, we'll also cover the pros and cons of organic growth versus doing acquisitions as a strategy. And last, we're going to talk about capital, the strategies of bringing in outside equity versus debt, and what are the real costs of each of those strategies. So with that, I will pass it back to Randy.
All right, so first thing that you need to do when you're trying to determine your strategy overall is this is going to sound silly for those of you with 10 or plus more units, but you kind of want to think about, what do you want to be when you grow up? That answer could be different for anybody that's on this call. Some people will be happy with 1 unit. Other people will want to have many. So as you go through that, the questions that you're going to want to ask is what's the availability of liquid cash, or what borrowing power do you have to be able to obtain those goals and figure out the strategy to get there? Next thing you could look at is are there territories available near you to grow within your current brand? And if there are not, then the question then remains, do you want to diversify into potentially another brand? Or if you're going to stay within the current brand that you're with, what challenges does that bring if you go outside of your current market? We've seen many people go from locations here in Michigan and then want to open locations in California or acquire locations in California, and that presents certain challenges in itself. As you're looking through that, you're going to want to have a comparative and how you benchmark yourself against similar franchisees. And most franchisors have some type of comparison metrics that you can compare yourself to your peers and how you're trending versus them. And ultimately, the lenders who are going to underwrite the transactions have similar information as well. So you want to make sure that you are always gauging how you're doing against your peers. And then lastly, what you really want to sit down and look at is, when it's time to exit, is your strategy to pass on to a relative, potentially sell to a manager, or an outside person? And each one of those varying options of the succession plan has differing impact on the amount of money that you can capture back after you sell or pass on.
In terms of planning your growth, we created a bunch of what-if questions that you should ask yourself. And only you as an operator knows what the answers are for you, because there's no right answer. So the first one is, what if I was able to buy enough units to double my size? That's really different when you're growing from 1 to 2 versus if you're trying to grow from, 5 to 10. You have a lot of different variables based on what your corporate structure is, what your overhead is, whether you have an office, whether you have district managers, regional managers, etc. What if I did try to diversify into another brand? We're seeing more and more of that today in franchising, and we are seeing that as a more prevalent way of people staying within their footprint to leverage their existing infrastructure, but multi-brand at the same time. We actually had this happen a number of years ago where a franchisee planned to open 2 units 6 months apart, and in fact, they ended up opening 2 weeks apart because of permitting issues. So you gotta worry about that kind of stuff. If you're trying to do multi-units at the same time, you want to make sure that you have a contingency plan for all those things. What if I bought some distressed units and that made a distraction of my running my business? We're going to talk about that in a lot more detail. And lastly, how would all of these things affect my current operations? Because as an operating franchisee, you don't want your existing unit performance to deteriorate as a result of you trying to grow. The term we coin is working on your business versus in your business. And do you have the management and the supervision to have that business continue to operate efficiently while you're working on growing it?
So growing organically, ultimately this means adding new units, not acquiring existing units. The benefit to adding new units is you have more control over the site selection. You're going to be involved in that process, and ultimately you have the ability to have say in where you're going to put the next unit or several other units. However, the challenge with that is, especially for smaller franchisees that don't have a lot of infrastructure, it's a very time-consuming process. You have distractions with respect to negotiating a letter of intent on the location, moving on to construction, contract negotiations, permitting, etc. Then obviously you have the impact of hiring people and training new people to go into the new location. With that, you lose some operating efficiencies because you're distracted as a smaller franchisee. Most people that are a smaller franchisee typically spend a lot of time within the stores, and so that additional work going out into the field, doing things outside of operating, can be distracting from the overall efficiencies. This type of growth many times has some challenges with financing, especially if you're in brands that have a slower ramp-up period, meaning break-even isn't for 6 to 18 months due to some type of membership-based business, etc. So many times lenders take a wait-and-see mentality, especially, again, if you're a smaller franchisee. They'd like to see some more operational results before they'll jump in and commit to financing new units. Larger franchisees don't have as much impact on that because they have more performance through their existing stores.
So growing organically doesn't let you get to scale as quickly as growing via acquisition. So we're going to talk right now about the pros and cons of acquiring based on performing units versus distressed units. They are two completely different animals. On the pro side, you have existing cash flows. You can You have no ramp time. You're just buying a business, buying the cash flow and folding it in. Financing is very available and actually the easiest financing to get out in the marketplace. You have staff, so you don't have to train everybody from day one. They're already open, so your sales will grow very quick from a velocity standpoint, and you can buy in bunches. You can buy a three operating unit network, a 5-unit operating network, all the way up. On the con side, there's a thing in your franchise agreement, just about all of them, called a franchisor right of first refusal. If you ever wondered what a ROFR was, that's a right of first refusal. We have had in this current year probably 8 or 9 transactions, or 8 or 9 units, less transactions, where the franchisor exercised that right of first refusal after it was all the way at the finish line. So everybody spent all their time in the beginning getting everything done, got a loan approved, went to landlords, and franchisor came in and said, no, I think I want these units back. So you want to make sure you pre-clear that in the beginning of the process. You also may be acquiring a hornet's nest of remodel requirements. You want to make sure you're on top of that. Deferred maintenance. Is everything up to speed? What are the AC units like? You want to make sure you have almost a home inspection done on these units, and you need to visit every unit. You want to make sure that the existing unit network has a good reputation in the community. You want to mystery shop it and make sure that their reputation is as good as yours, or if it's not, that you have a plan to make it better. On the flip side of having existing staff, they might have a completely different culture than you do, and you're going to have to make sure that you explore that and address that when you inherit staff, and especially store managers. You might have a different management style than the old owner, and unfortunately, in a lot of these transactions, you don't get to meet these people until the 11th hour. So you really need to make sure that you're comfortable and that you have a plan to deal with all these different variables in acquiring units.
So on the flip side of acquiring performing units, you can take a look at acquiring distressed units. The benefit of acquiring a distressed unit is many times it comes with a lower purchase price. There's typically losses or minimal profits, so therefore you can get a better purchase price on that. You also inherit some immediate staff as opposed to having to hire and train new people. Therefore, you can bring in, or you have more efficiencies that way and less distractions. With the unit being already open, you have the ability to plug and play managers, especially some of the larger franchisees can plug and play existing managers or area managers into a location, and therefore, especially if you're acquiring in a location or a territory that's near your existing units, there's some velocity there that can be gained. Also, you can buy them in bunches. Typically, many times when we see distressed units being sold, it's typically the franchisee that's having problems. Therefore, you can buy them in bunches from a single franchisee. Going through the con side, many of this is actually duplicate, as you'll notice, of what Ron just mentioned there on the performing units. I would say that the difference, though, is typically you'll see more deferred maintenance many times when people are struggling. They have the tendency to defer any upkeep, so there could be additional costs associated with that. So before you go and move into the units or establish the purchase price, you want to make sure that those are assessed. And kind of going down the other bullet points, again, similar conversation. However, on poor performing units, you typically have reputation issues, culture issues, and inherited staff might have issues. So there could be some cleanup necessary as you kind of go through the distressed acquisition process. most of the successful or large multi-unit operators that we've worked with have bought several distressed units and with the thought of turning them around. And so it is a great strategy. Just be careful that you have the infrastructure to handle that. Looks like we had a question come up. Would like to hear about how to find these distressed opportunities. So Dan just mentioned we'd like to hear how you find these distressed opportunities. Typically the franchisor knows about them. Many franchisors have a bulletin board that lists units that are for sale. I don't think they advertise that they're distressed. They just advertise what's for sale. Many of your franchisees also, you're in a large network of people, so communicating and at the conferences that you all have, attending those, there's typically people that are looking to sell units at those. And there's also franchise brokers that sell franchises that also have people that are selling distressed units that you could also contact with. And then the next question. Okay, you got that next question. Thanks, Ron.
Yeah, and the other place you can look is if your franchise brand has a benchmarking portal, or you have transparency into all of the units. Just look at the bottom 25% and see if they map to your area, or if you have any interest in them, and you might be able to just make it as easy as that, and then just go and approach those franchisees directly and say, hey, you're having a tough time. Do you have any interest in getting out? Mining your own brand is the best way to do that. If you're looking outside of your brand, the broker route is probably the best way to go. Moving on, the other thing you want to make sure on all these acquisitions that we didn't actually put a bullet on, it's kind of a common sense thing, is you want to make sure you have enough lease runway and real estate runway if you're planning on keeping them in that location to amortize your debt and get ROI on your investment. In terms of financing performing acquisitions, it's like I said, it's probably the easiest thing to do. It's easier than developing new units because you've got existing cash flow that a banker can underwrite. You generally need between 10 and 20% equity in each deal. You can leverage your existing equity. We'll talk about that a little later. To cover the down payment or even higher than the down payment. What they're going to look at is a global analysis of your business, your capital stack, your actual indebtedness, your guarantors. Where there are a lot of pitfalls here is when you have 5 partners in one entity and only 1 or 2 or 3 of them are going to acquire these next units. And in the next unit, and it works the same way in organic growth, the non-participating shareholders in the acquisition or the growth aren't going to want to guarantee the debt for the acquired growth. So it's much harder to leverage your existing business if you have different shareholders. As I mentioned, you have the lease and the expiration and the options and rent increases. CapEx requirements are something you need to have documented because the smart lenders are going to ask you about those. And then you always want to look at, especially in service brands with high gift card, and we have a lot of those brands in our portfolio where there's a lot of gift card liability or prepaid liability. You need to make sure that you do a thorough analysis of that and have a reasonable negotiation with the seller. In terms of leverage rates, generally 3 to 3.5 times the EBITDA of the acquired company, with the balance coming from your cash, seller financing, or embedded equity in your business. Again, we'll cover that in a couple of minutes, but 3 to 3.5 times is generally the current market. We are in a rising interest rate market and a soon-to-be contracting market where it's going to get tougher to borrow money, in our opinion. So you want to probably stay closer to that 3 times if you're thinking about doing that. As if you see rates going up, that 3.5 will become 3 very quickly.
So acquiring or financing acquisitions for distressed units is significantly different. Financing is not as readily available, specifically for smaller franchisees buying distressed units or people with no franchising experience. Buying distressed units is a tough loan for any lender to provide financing for, especially people that have no franchise experience looking to buy a distressed unit. The conversation from the lender's perspective shifts to, well, the franchisee that was there couldn't do it. Why do we expect you with no experience to be able to do it? So then in those scenarios, typically what happens is the borrower, the franchisee, typically has to finance the majority of the project, if not all of it. When you start to transition to franchisees that have anywhere from 3 to 3 and above units that have existing cash flow from their existing or from their operations, and that is a way that you could then finance the acquisition of a distressed store with the assumption that the losses aren't so great that they're eating up all of your cash flow and you can't make the payments. Typically, when you're looking at distressed units, you want to make sure that you're assessing their cash flow specifically to how you operate your locations, and then go through them with a fine-tooth comb. Many times on distressed units, there's the potential that the franchisee, the existing franchisee, may be trying to inflate cash flow or ultimately be running so thin on labor and food that it's not feasible for you as a new owner to do that. If you're trying to meet brand standards with respect to the number of employees in the store, management, etc., that's typically the first place to cut for people who are struggling. So just make sure that you're assessing the operations, financial operationals, and determine if you can realistically run the store in the same capacity. As Ron mentioned previously, this is a similar review. They're going to do a global analysis of the cash flow. And when I say they, I mean lenders. Apologize. Lenders will do a global analysis of the cash flow, current debt, and check all the ratios, etc. So a lot of this is the same, and it's more applicable to larger franchisees than first-time or second-unit franchisees. Again, review the leases. Make sure that you're going to be able to be in the unit for as long as your debt or as long as you want to be, and certainly as long as a franchise agreement. The other aspect here is CapEx and requirements, and that's ultimately any equipment upgrades or remodels that have a larger impact on an underperforming unit. If a unit's losing money but you're required to put in a large expenditure to get it up to brand standards, that can have a larger impact on you. The piece here that I would say is a differentiator, and I alluded to it a little bit earlier, but when you're looking at debt financing, if the seller has losses, if you're going to finance it, then 100% of those losses need to be covered by your operations with a cushion. So if you have $100 in loan payments or expenses, then you need to bring in anywhere between $125 to $135 to cover those payments. That's what it means by with a cushion. Ron, you there?
I'm here. I'm sorry. Can you hear me now?
Yes.
Okay. So for the next few slides, we're going to cover capital strategies. First thing you need to do is set your goal. Most people's goals are those 3 bullets that you see below. You want to pay your living expenses. Hopefully you don't live like Johnny Depp and need $2 million a month to live. You want to build wealth for your family, and you want to make sure that you satisfy your partners. And by your partners, That doesn't necessarily mean your business partners. It means your spouse. It means your franchisor is really your partner in your business. So you want to have those three things as a framework for how you go about capitalizing your business as it grows. And how you've capitalized it for Unit 1 is probably going to be very different than how you've capitalized it long term.
So most people, typically we are Americans, for most of us on the call here, like to get into debt when they grow their franchise. Ultimately, when you're leveraging somebody else's money to be able to grow and increase your net worth really is the goal of this. A new unit financing, many times most of the time, matter of fact, all the time, it's pro forma-based financing. And so there's lending available for pro forma-based underwriting. In other words, there's a projection that banks are assessing to determine how much money they will lend. There's also ways to leverage your personal assets to facilitate growth, and utilizing 401k investments. There are ways to access those without penalties and tax. Certainly personal cash, etc., home equity are all options that you could utilize for using your personal assets. Utilizing debt typically without involving other partners means that you own 100% of the business, and you can use the leverage to be able to turn your units into cash cows for you and keep it to you and your family. The risk that you have by utilizing personal assets is that if you're all in and you have nothing left and you haven't used any financing, then you have to be very confident that your team and operations will be able to sustain that for you. So many times combining personal assets with debt is really a safer route and quite frankly probably gets a faster return on personal cash investment.
So looking at equity, one of the things I think your takeaway should be is that equity is the most expensive way to fund your business. Doesn't seem that way, but I'll give you a couple of pointers to it. However, you got to ask yourself a few questions. Do you have enough financial capacity to get to where you want to be? By that, if you want to own 10 units, you're going to need a total of X dollars, and 20 to 25% of those dollars need to be equity. How do I get there? And if I can't get there with my own personal assets, I might need a partner. And then there's different kinds of equity. There's just money, and just dumb money is really good sometimes to have passive folks. And then there's also smart money. Might be another franchisee in the system who's bigger, who would like to diversify and have more assets. Might be somebody in another system. And with that question, you have to ask, do I need more than cash? Do I need just cash, or do I need a smart partner to get me to the next place? Part of that is a personal assessment of your abilities to manage a larger organization and your team's abilities to scale. You got to ask all those questions up front. And then you can decide on debt, equity, or hybrid, which we'll talk about in a minute. The positive to equity is you don't have to give anything back if it's straight equity, but there's all kinds of variable kinds of equity where they want a current return. Got to be very careful there. In that case, all of your cash flow can get reinvested for growth, and you can grow faster by having more dry powder to put down on more units. The downside is that equity holders don't go away, and they're going to get a share of the potential sale of your company when that time comes. And quick example I'll use is you raise $100,000 and give somebody 30% of your company. Then you build the company into something that's worth $2 million, and they get 30% of $2 million, or $600,000. So that $100,000 of equity cost you $600,000 on the exit. Was it really worth it? Sometimes it is, sometimes it isn't. You just need to do the analysis up front. Again, part of your plan that we discussed early on in this program.
So a question popped up on one of the last slides. It says, what's your opinion of a 401k/IRA rollover products for the purposes of acquiring a business? I think they're good products. I think you just need to assess the long-term impact and what if it gets you to your long-term strategy. I don't think there's anything wrong with those products. Many times we've seen people combine a use of the 401k rollover and combine it with debt. Many times I've seen people pay for an entire project or acquisition utilizing the 401k rollover. I think it's typically a personal decision, and does it get you to where we started this conversation or this webinar? Does it get you to where you want to be? And if that's a tool that you can use, I would say yes. I think it's a good strategy. I certainly would use one of the companies out there that specializes in it. There are implications if it's not set up correctly. There are IRS implications if it's not set up correctly. So I would make sure you do it with somebody who knows what they're doing. So the next discussion here is a hybrid, and typically a hybrid is some type of combination of adding a additional partner and also debt. And this is a pretty common tool that I've seen used for people who are growing quickly or have a big acquisition that comes across their table that's a little bit more than they can afford with themselves. So they typically bring on a partner that has some type of liquid cash that helps with the down payment on a loan. So you don't have to give up as much of the ownership or as much of the profits that Ron alluded to when we were talking about equity. Typically in an equity situation, they're just putting in cash with not a combination of debt. When you combine it with debt, you don't have to give up as much ownership. And ultimately, there are some challenges with that. There are some typical ownership percentages that if you typically go above 20% for any partner addition, then they then would have to guarantee a loan. So there is some structure things that you need to look at to assess if they're going to be able to put in the equity without providing a personal guarantee. If they are the person that has the majority of the cash and it's a large acquisition, many times the banks do want them to be on the hook. So it's a great strategy. Doesn't require you to give up as much ownership. Therefore, when you go to sell, you get to keep more of the benefit. The challenge is there's some trickiness to it with respect to making sure that everything is set up legally correct, and then also what are the expectations moving forward with respect to return on profits and ultimately the sale of the business. So you just need to make sure that all of those things are considered in advance prior to entering into this type of situation.
I'll just add, you got to be careful ultimately, even if you're bringing money in post-growth. We had an instance in our company this year where one of our borrowers who had a sizable amount of debt with us brought in a private equity fund as a 25% partner and triggered the requirement for that private equity fund to guarantee all of the debt of the company. And it turned into a bit of a mess because they hadn't considered that until after the fact. So you want to make sure that you are very, very careful, read your loan agreements, and understand the fine print. Even if you've already gotten through your growth and you're just looking to take some money off the table, you might trigger some things that are unpleasant after the fact. Talking about the pros and cons of products, in terms of speed, SBA is probably the slowest process to do anything. It's also probably the most painful process. And if you're doing acquisitions, If you're already an existing operator, if you have less than 5 units, you have fewer options than if you have more than 5 units in the conventional world. Our ApplePie Core product will work in either instance as long as you have existing cash flows and are doing acquisitions. In terms of pledging personal collateral, SBA will require it just about as a rule. ApplePie really never requires it. If it doesn't work on the merits of the deal, we won't lend the money. And in a conventional world, sometimes it is required and sometimes it isn't. First unit financing, your choices are SBA or in a very, very select group of brands, ApplePie Core. Conventional lenders really won't do projection-based financing. They'll do development lines of credit based on your existing cash flow, but they're not going to lend beyond your existing cash flow. For there, you're really looking at ApplePie and SBA. In terms of getting multi-unit commitments up front, pretty self-explanatory. You're going to get that. You're really not going to get that in SBA, especially if the units are going to open more than 1 year apart. In terms of loan covenants, that's where SBA shines. Generally, SBA loans have no loan covenants outside of a reporting, an annual financial statement reporting. Just about everyone else has some form of loan covenants. And whether it's available for most brands, again, that's where SBA is. If you're in a challenged brand or a very young emerging brand, SBA is going to probably be your best bet. You're not going to get access to loans where the lender doesn't have Uncle Sam co-signing the loan on your behalf.
So what should a capital markets partner do for you? Number one, especially on acquisitions, well, even on startups, but on acquisition, somebody that understands your brand and the industry is really imperative. Franchise acquisitions trade anywhere from 3 times cash flow to 7 times cash flow, depending on the brand. 7's pretty aggressive, so there's not very many that do that. But ultimately, point of it is somebody that understands your brand and understands your industry is going to know where those will trade and quite frankly can give some guidance with respect to the purchase price, not necessarily telling you whether it's a good purchase price or not, but if seeking financing is part of the strategy, they'd be able to let you know what the expectation would be for down payments at a given multiple, and et cetera. So that's imperative when you go through this because every lender has difference of opinion on that. The capital markets partner would typically have programs set aside for you as a franchisee of a given brand. And so they've done their due diligence, reviewed the strengths and weaknesses of the brand, know what works, what doesn't from the franchisee perspective, and create programs specific to the needs of that brand, acquisitions or new store development, et cetera. Ultimately, what's really important is this last bullet is their goal, a capital markets partner goal is for you to keep coming back to them. So therefore, the loan product that they put you in it would result in success. They want you to be successful in an effort for you to grow and continue coming back, especially in the franchise industry. It's a tight-knit community, and therefore the correct capital markets partner would be able to look at your situation and say, we think an SBA product is best for you, we think a conventional product is best for you, or an ApplePie Capital Core loan is best for you, and give you solid reasons why. And ultimately, 90% of franchise lending is cash flow based underwriting. So therefore, the type of product, every product that's out there has a different loan terms, covenants, et cetera. So our job is to inform you of the risks, the benefits, and make sure you've considered all options is what a capital markets partner would do.
So you're all asking that crazy question, how much can I borrow? The first question everyone asks us. This is a screenshot of a calculator that ApplePie Capital has, and will be on the next slide, a link to it, where you can figure out what your borrowing power is of your existing unit network. It's pretty simple. You enter a few variables. It's not unlike a mortgage calculator. And we will tell you what your borrowing power is. That borrowing power only works in the brands that ApplePie Capital has approved. If it's a brand we have not yet approved, we have a chance to approve it, but it will work immediately in the brands that ApplePie Capital has partnered with. And if you're in one of those brands and there is an ApplePie Capital dedicated landing page for your brand, you probably have it in some email buried from your franchisor. Go on that and it'll be specific to your brand. If you're not currently profitable, this is not a good page for you to go to because you're not going to get a good answer. So you really want to make sure that you have existing cash flows. And if you're not currently profitable, you probably shouldn't be growing either. So you're never going to buy your way or build your way out of unprofitability. You have to fix the problem and then move forward. So don't fall into that trap. A lot of people do that, and then you end up with a bigger problem later on. Again, the link was just sent out via the message to everyone. It's pretty simple, www.applepiecapital.com/grow. And I'll turn it back to Randy for the final slide, and we're ready for your questions.
Yeah, thank you for everybody for attending. We appreciate it. As Ron just mentioned in the chat link down there, in the chat window, there's a link to the growth calculator. Also, you can either email us at loans@applepiecapital.com, and also feel free to call. That's preferred. It's 1-800-720-0241. And it looks like we have some questions coming in here, which is great. Keep firing away. Ron, why don't you take the first, and then I'll take the second.
Sure. So the question came, how does owner's compensation affect EBITDA in this case? In many times, it's an add back. If you have management in place and the units operate, whether you're there or not, it's just about always an add back. So that's a good thing. If you're acting as the manager and somebody buying it is not going to be the manager, then it wouldn't be a full add back, but the add back would be the difference between the market value of the manager and what the owner's taking. I can tell you that compensation is generally acceptable. Living your personal life through the business checkbook becomes very questionable, both on an add back standpoint and a character standpoint from most lenders' perspectives. So you really want to run a clean set of books and records when you're accessing capital. Randy, why don't you take the next one? We got a couple more coming in. That's good.
Sure. So the question is, what's a typical time frame from application to approval? We help with the various loan products that we just referenced throughout the webinar. Each one of them carries a different approval time, so I'll go through each one of them kind of as a rule of thumb. Some go faster and some go slower, but I'll just give a rule of thumb. Typically, an SBA lender is going to be slower than either our direct lending, ApplePie Core, or a conventional lender. A firm commitment letter from an SBA lender typically takes anywhere between 2 to 3 weeks, sometimes up to 4, depending on how complex the borrower or transaction is. ApplePie Capital Core and conventional lenders are typically the same. Typically, the approval time is anywhere between 3 days to 2 weeks, again, varying on the complexity of the buyer and the seller. If it's new unit financing, it's typically closer to the week to 2 weeks. Usually, we would give you an indication, depending on the type of lender, whether it's SBA, conventional, or our core product. typically a proposal letter is offered anywhere between 2 to 5 days, again, depending on the complexity of the project.
The other question we have, and that's to approval, that's not to closing. Closing times vary greatly depending on how many landlord waivers you need and a bunch of other variables, so we don't like to put numbers on that. I can tell you that SBA will be the longest closing period, and ApplePie and conventional will be significantly shorter. Question came, when using the calculator, should we include the EBITDA from the stores we're looking to acquire? So you should look at it both ways. Look at it from your existing cash flow, and if you have borrowing power in excess of your current debt, that embedded equity can act as your down payment, your 10 to 20%, so that you don't have to come out of pocket as your down payment on the acquisition. And then you can look at it, pro forma as if you're together and see what embedded equity you'll have after the fact to continue to grow. So I would just run your scenario both ways in the calculator, and it'll give you a rule of thumb. Obviously, it's not a firm commitment and subject to all of the normal underwriting guidelines, but that should give you a good rule of thumb. With that, I think the questions are complete. I would like to...
Actually, there's a couple more.
Okay.
I think there's a couple more, right? You might have scrolled. So it says there appears to be a disconnect between first-time buyers and 5+ unit owners. What are the best options for owners of 1 or 2 units and looking to acquire additional units? It's a great question. So just to be specific here, it says acquire, so we are talking about acquiring existing units, not opening new stores. The benefit of a 5+ unit owner is they typically have more equity into their current stores, and therefore in buying distressed units, then it's not as much of a strain on their cash flow as what there would be for a 1 to 2 unit franchisee buying distressed locations. Certainly, you could have 1 or 2 units that are killing it and knocking it out of the park with respect to cash flow, and so therefore a distressed unit may not be very impactful. But if you're kind of running average, then as a smaller 1 to 2 unit franchisee, buying a distressed unit typically impacts you harder than the 5+ unit. Financing is still available for that. You just have to do a global cash flow analysis. Acquiring existing units that are performing as a 1 to 2 unit franchisee certainly is feasible, and we do it all the time. So I think it just depends on the situation that you're looking at.
So the next,
you see the rest of these? Yeah, go ahead.
Yeah, I see a bunch of questions coming in. Okay, we're going to try and go rapid fire here because we're running out of time. The next question is the person is asking for a list of brands that we support. We don't publish a list of brands that we support because if we published it, then every bank in the world would see it, and we wouldn't have much interest in creating that as an easy ask for them. I can tell you, the person who asked the question, that both of the brands that you asked about are in our portfolio, so you'd be fine. And you should give us a call and talk about your individual situation, and then we can have a good conversation. So I'll ask that person to shoot us a call or an email, and we can have a conversation with you right after this call.
Yeah, and just to couple on top of that, based on the situation provided there, that's something that we could look at. So I think it'd be an individual transaction. Okay, next question is, when looking at acquisitions and using EBITDA for the stores looking to be acquired, do we use actual EBITDA or the immediate EBITDA we expect based on our operations? Could be higher or lower than actual. Really good question. So ultimately, the person is asking is, if, let's just say, your units run historically an average of 10% profit margin or EBITDA margin, and the stores that you're looking to acquire are only operating at 5% EBITDA margin. And how would you look at that? So for your analysis and reviewing it, I would be conservative and look at the 5%. From a lender's analysis, you could potentially go to and do a recast of the way the stores are performing or will perform based on your current operations. Going the opposite way, if there's a greater EBITDA margin on the stores that you're acquiring than how you operate, you're going to want to analyze why you think that is. Many times with certain brands, there's a level of management required once you get to a certain number of units open, which typically deflates the buyer's EBITDA margin, but acquiring the existing stores would spread that out throughout more locations. So it could improve your existing operations as well. So I would look at it two ways: your perspective, but then also how's the lender going to look at it.
The other thing you want to look at is it's a lot easier to take expenses and normalize them than it is to normalize revenue. So if it's because they have the sales but the expenses are too high, you're much more apt to have a lender buy in on using your expense model than it is for you to create sales. Next question is having diversification in one DMA. One brand, 6 units versus 2 brands, 3 units each. That's a personal decision. It also is a real estate decision based on what real estate's available in that market for you. If you're in a brand where there's green space in your home market, I would probably opt to build as many units in that brand as I could in that market, so that you could, perhaps control a part of that market for yourself. It makes it much easier for you to shuffle staff from location to location because they're all cross-trained in the same brand. But it is a personal decision for you. And we have less than a minute left, so I'll wrap it up. The question is, for a multi-unit operator that is expecting to do a new build early next year, how early is it to secure financing? If you are doing a new build next year, you want to talk as early as possible, get pre-qualified, understand what products are available to you. And at the point where you want to actually make formal application is when you kind of have a location identified and you know what your rent's going to be, or at the LOI stage. We like to engage at ApplePie very early so that we can give you the landscape of what's available, and you can decide earlier on what the best options for you are. And with that, it's at the top of the hour, and we're going to call it to a close. I want to thank everybody for being on board and attending. We'd love to get feedback from you. If you could shoot us a note or stay on and put a chat in on your thoughts. There's also a bunch of emojis. We'd love to see, happy faces and thumbs up, but we'll take whatever you give us. We want to make sure we do better as we grow. And thank you all, and we look forward to talking to all of you. Take care.
Thanks, everybody.